I don't offer financial advice. All I can give you is information, and you can decide what you want to do with that. So, important disclaimer, I'm not telling you what you should do. Do not appeal to authority and that, Huggins told me this was a good investment idea or anything like that. I'm not offering any of that. What I can hopefully do is illuminate some of the things that are going on and give you a bit of context about how to make your own investment decisions under these circumstances. Secondly, I don't sell anything, so I don't have any products that I can directly point you to as saying, "Oh, this is what I'm trying to encourage you to buy." So I don't have any stake in any of this. And again, everybody should kind of take their own judgment. If you hear something you think is clever, bring it to your banker or your financial advisor. Ask them for a second opinion on that. Do not run with whatever you happen to hear from me. Appeal to authority is a terrible logical fallacy. Don't fall for it. That's it. All right, so it's been a little bit since we had our first talk about this in March when our residency got canceled. And we decided to just have a sort of a quick chat about macroeconomics in the context of COVID pandemic, mostly because we were all just going into this and it was really questionable exactly how this would play out, whether this would destroy our economies, whether this would create opportunities for certain kinds of firms. And some of the stuff, I went back and I watched that video, some of it was pretty on point. If you made an investment in Zoom, you probably did pretty well, for instance. But otherwise, it's not really about being able to make right or wrong calls, in my opinion. And it's more about just informing people about what is kind of going on in the big picture. So that's what I want to get into today. So when we're looking at the impact of COVID, I guess the first thing we should kind of point out is the vaccine timeline, right? We've all, I'm sure, heard in the news by now that there's a number of different vaccines that are making their way towards us, and some of these have more complications than others. Now, thankfully, as we've been discovering more and more about these vaccines and putting them through trials, we're finding out we don't have to keep them quite as cold as we originally thought. But the first vaccine that people had rolled out with high efficacy had to be stored at colder temperatures than -70 Celsius, which is a seriously industrial, like science lab grade freezer that they don't have in most hospitals, let alone in pharmacies where they'll be able to actually offer this vaccine to people. So there was a lot of concern about, this being a flash in the pan sort of thing. But we've seen a couple of other vaccines roll out that can be kept at warmer temperatures and they still retain their efficacy. So this is no longer a sort of, high in the sky view of our future. Instead, what we're looking at is the possibility that this is going to come to an end, hopefully within the next 9 to 12 months. So the only thing I have that gives me any sort of historical timeline that approximates this is taking a look at the pattern in the Spanish flu immediately following World War I. They had 3 major waves of it. The second one was probably the worst of them. It's probably going to work out a little bit something like that. I don't want to say that it will be the same because that's bad statistics to assume that things are going to necessarily repeat in that way. But the Spanish flu did take a full 2 years to run its course, and they had 3 major waves of it in that time. We're arguably going through a second major wave of COVID-19, and we may very well have a third one as people start to relax a little bit and feel that this thing is beat before it actually gets beat. Everyone's in a hurry to get back together. Everyone's in a hurry to go and sit in the park and a restaurant and have fun again. But if we let up our vigilance too quickly, we could very easily find ourselves back where we started. So there's a notion about how long this is going to take. And at least now that we have vaccines, there's a notion that there is light at the end of the tunnel. Roughly speaking, we're talking about 9 months before we have a critical mass of people vaccinated in Canada. Anywhere, I would say the very, very best case scenario, we will get about 2/3 of people vaccinated in about 6 to 8 months' time. That is the best case scenario where everything works fine and nothing goes wrong. More realistically, we're looking at having that 75 to 80% of people vaccinated by the end of next year, which means that we can probably get together for Christmas next year with our families, even if we have to stay home this year. So the implication of that is that there's a lot more blood to be shed yet. Even though it's nice to say, in 9 months, I'll be in the classroom again. The fact is that we're going to bleed for a while. Case numbers are still spiking in a lot of places. Alberta yesterday had more cases than Ontario. BC is the current reigning champion for infection rates. And so there's still a lot more pain to be felt from this. There's going to be more lockdowns coming as we try to get through the winter safely. But a lot of areas are having difficulty. And one of the biggest problems has been pandemic fatigue. People are just tired of doing the thing that they needed to do. Most of us thought that this would hopefully go away in a few months, but it did not. And so as a result, we're finally getting around to adjusting to life under that sort of pandemic. And this has had major implications for the structure of aggregate demand and aggregate supply that I'll be talking about in a little bit. But I wanted to first off establish that we do have an end to this in sight, but that we have a timeline of things which is going to take place between now and the end of this. My ballpark would be to break it into 3-month seasons. And I would say first, we're going to bleed for another 3 months. It's going to be bad. There will be more deaths. There's going to be a lot more hospitalizations, and it's going to be a pretty dark winter, no matter how we slice it. Even if there's hope for the fall next year, there's still a lot of problems coming this way, and a lot more business failures are going to happen this winter than we've seen in the prior 6 to 9 months. After that's happened, it's going to take us a little bit of time to just sort of bottom out. Like any kind of recession, for instance, we are going to hit the bottom, and it's going to take us a little while before we can start to climb. So I suspect it's going to be at least 6 months from now before we start moving into recovery, and about 12 months from now before we have anything approaching normal. So 2021 is going to be the year where we finish bottoming out and in all likelihood begin getting back to normal, as it were. But I would caution you that normal is not going to be a return to 2019. We've had significant adaptation to this change, and that's unlikely to just suddenly go away or become irrelevant. So there is going to be some substantial changes coming down the pipeline. In the meantime, broadly speaking, GDP followed a pretty significant cratering path, as we all suspected it would in second quarter with all lockdowns in various countries around the world. So GDP pretty much collapses in Canada and declines by as much as 10, 11% in Q2, and then begins to bounce back in Q3. And we've been seeing a return in Q4. Things are starting to slow down as we're going into this sort of dark patch in the winter again. But arguably, we're operating at about 95% when it comes to Canadian GDP compared to where we were a year ago. But that has been really uneven, right? We don't always necessarily have every industry operating at 95% or at 95%. Some are really flying on one engine right now, and others are profiting dramatically well. So it's worth, I think, highlighting not just the aggregate situation, but trying to identify some of the sectors that have done well and some of the sectors that are still bleeding hard and where we're likely to see increasing number of bankruptcies in the next few months. So compared to February, benchmarking these various industries against February, as of the end of October, these industries were actually larger, doing more business than they were just 8 months before. Interestingly enough, general merchandise, we are selling more stuff now than we did before, which is a bit unusual until you realize just how easy it is to click a button compared to picking up a product, standing in line with it for 10 minutes and realizing I'm going to buy something worth $200. If you click a button, it's already done. It's too late. It's at your house. So interestingly enough, general merch has done well. And in Canada in particular, our standard bearer there has been Shopify. Shopify has done remarkably well in the last few months as everybody's wanted to open an online store. So unsurprisingly, businesses that make opening online stores possible are thriving. Another one that's done unusually well that hadn't really been expected is real estate, right? Construction has really kind of kicked up as interest rates have come down. That's to some extent reasonable to expect. This is not a regular recession. And people are anticipating a return to normalcy, I suppose. And they're anticipating, of course, that people are going to want to adapt their homes to more longer-term work from home solutions. So there has been, weirdly enough, a lot of activity in the real estate space. And construction companies, which normally do very poorly during economic downturns, seem to be doing pretty well. I suspect part of the reason for this is that there has been government rollout of funds towards, directed towards infrastructure projects. Now, most of these haven't hit shovel-ready position yet, but we should see the kind of boom that we saw in construction sustained as we move into government spending on infrastructure in 2021. Other areas that did well, utilities are up. Unsurprisingly, everybody stays home, and I guess they use more electricity. But utilities are faring well. Finance and insurance is faring well. And interestingly enough, food and beverage stores are doing well. Sobeys is doing more business than they were before because we're not going to restaurants for food anymore. We're having some of it delivered, but for the most part, we're buying it all in grocery stores. So companies like Loblaws or Sobeys have done quite well in this situation because they're able to push more product through their existing stores. So even though they're really thin margin, the fact is that they're able to push more product through because everybody's buying at the store now rather than getting it from secondary providers like restaurants. So there are a few areas, and these areas are not doing spectacularly well. The only one that seems to be really holding up well is e-commerce, and that's mostly because Canada was not as developed as many other nations were in terms of e-commerce, but we had the resources to rapidly deploy it. So growth in that sector has been really astonishing, but a lot of that is Canada catching up to other countries that are leading in that space. Meanwhile, there are certain industries who are absolutely devastated. The airline industry is operating at like 20% capacity compared to what it was in February. So the equity is bleeding out of these firms incredibly quickly. And there's really serious question as to whether or not there aren't going to be some major bankruptcies in the airline sector. Because even though they can cut back on the number of flights that they run and thereby cut back the accumulation of variable costs, there's still fixed costs associated with having a fleet of airplanes, even if they're grounded. You've got maintenance to worry about. You can't just pick out an airplane that's been sitting in a field for 2 years, fire it up, and fly people across the ocean. There's a lot of asset maintenance that has to take place. You have to consider the cost of financing these things. And so even if Air Canada is not flying, they're still bleeding cash. And there's only so much money they have to sustain a business that's operating in a 20-25% capacity. When we look at the hotel industry is getting slaughtered. They're operating at somewhere between 40 and 50% capacity these days, mostly because, especially under lockdowns, nobody's traveling and not a lot of people are staying in hotels. So they're having a particularly bad time of it. The hotel industry is getting rocked by this, and they're going to keep bleeding, just like air travel will, for at least another 6 months until people feel confident enough to start traveling again. Arts and entertainment, recreation is getting devastated. Having worked in music before, I can tell you that most small bands make their money by selling merch. They tour, they collect money for playing shows, but most of the time it's not record sales, it's not even shows that makes money, it's selling t-shirts on tour. So because there are no tours, bands can record albums, but you'll notice that most of the time albums come with tours, and since there's no ability to tour, most bands are holding off on their releases this year. Similarly, entertainment in terms of, say, going to shows, it's come to a grinding halt. For instance, if we take a look at Broadway, Broadway producers are bleeding hard right now. They've got really expensive theaters there and they just can't put people in them. So things like Roy Thompson Hall are going to suffer from this because they can't put 1,000 people safely in the same place for hours and hours at a time. Venues like the Opera House or the Docks, even Ontario Place, are going to suffer dramatically from this. So we've seen a lot of little bars around Toronto that used to provide live music spaces, for instance. They're all closing up shop too. They can't endure another 9 months of this. And so we're again seeing that kind of supply destruction. That's going to be very costly for us to build back up later. Other areas that are hurting, transit generally has a lot fewer riders everywhere. So municipal governments or transit companies that are relying on user fares are also suffering. Even food and beverage, so like bars and restaurants, they're operating at somewhere between 60 and 65% capacity before the most recent lockdowns. And that means that there's no way they're going to be able to earn enough money in order to cover their fixed costs. And so we're going to see a lot of attrition in the restaurant space as well. Larger chains, Harvey's, things like that, McDonald's, Burger King, Domino's, these may survive, but remember that a lot of these little restaurants are in fact franchises. And individual franchisees may not have the deep enough pockets to sustain their businesses through this difficult environment. So we do expect to see more businesses disappearing, and that's going to push more people onto unemployment, unfortunately. So that leads me to talking a bit about government responses, because of course more people unemployed eats into aggregate demand. And you'll hopefully remember from 602 that in general, when we see a decline in aggregate demand, the standard response for the last 100 years of governments has been for government to make up the demand by increasing its spending when household consumers reduce theirs. And this is effectively the Keynesian solution. So governments, particularly in Canada, have been throwing tons of cash at this problem. We have a variety of different programs. We introduced the CRB, CWS, et cetera. Now we have an EI expansion, and all of this costs an extraordinary amount of money. As I'm sure you've picked up on just by listening to Canadian news, our deficit is 11% of GDP this year. This is staggering. We haven't seen a deficit this size outside of a war, ever. And it gives you some idea of how big of a problem this necessarily is. This is a national emergency. Now, it's pretty easy to recognize that there are a lot of government spending going on, but people often ask, where is the government getting the money from? Are they printing it? Because if they're printing it, we should expect a lot of inflation. So I spent a couple of days decoding where the government is getting its money from for you, so I can explain to you the process of why we're not going to see huge inflation in Canada as a result of our quantitative easing program at the Bank of Canada. The reason we won't see a lot of inflation in Canada is because in order to finance all of this government borrowing, right, to the tune of hundreds of billions of dollars, we did not create more cash. We did not turn on the banking pen. We didn't run the printing presses, print up a bunch of cash and deliver bags of it to the government. Instead, what they did is the government issued bonds. The bonds were sold in the market to our prime brokers, and then these were bought back by the Bank of Canada. So in a roundabout way, the Bank of Canada has been buying up the government's debt. Now you might say, okay, that's nice, but where's the Bank of Canada getting $300 billion from? I've seen that organization's balance sheet. They don't have $300 billion laying around. So where the hell are they getting the money to support this much government debt purchases? Because if you look at the balance sheet of the Bank of Canada, there's been a massive expansion in terms of their purchases of both government bonds and treasuries and provincial securities as well. So normally this is where the question comes up, where does the central bank get the money? In the States, they basically gave people the bank's reserve credit, which basically meant that they were saying, well, we're going to buy up your long-term assets and we'll give you an accounting entry in exchange. In Canada, we've done QE in a somewhat different way. The money for the central bank to be able to make these purchases shows up on the liability side of the Bank of Canada's balance sheet. So I'll show you really quickly a graphic that I made of what this looks like. See if I still have it here. I just basically pulled data from the Bank of Canada that looked at all of, I didn't save it, that's unfortunate. Anyways, it was basically looking at the composition of its assets and composition of liabilities. And you can see all of its assets are massively expanded to government bonds. We've quadrupled the size of the Bank of Canada's balance sheet in this year. So where did it get the money from to buy all this stuff? It borrowed it. Rather than create the money, it borrowed $300 billion from our banking system. Right? The members of Payments Canada have been ponying up all this extra cash. Right? Where has all of this extra money for the Bank of Canada been coming from? Well, on their liabilities side, the largest single liability the Bank of Canada has is borrowing from the members of Payments Canada, which basically means they're borrowing from our big insurance companies, they're borrowing from our pension plans, they're borrowing from our banks. All of the major institutions that are tied up in our payments network, they supplied emergency liquidity to the Bank of Canada, who then in turn supplied it to the government. So this is not a problem. This is actually kind of how we want it to work, right? We want our savings to end up being channeled into demand, because you'll remember in the Great Depression, we didn't spend our individual money. We all tried to hoard and save our money because things were bad and we didn't spend. So the governments had to ultimately borrow a pile of money to force extra demand into the system to prevent unemployment from going out of control. And that's what we've done here. We've allowed our government to effectively borrow our money through our banks and the Bank of Canada in order to redistribute it across society. Now, arguably, this is more reasonable than simply printing up a bunch of cash, which effectively steals money from everybody else that has a fixed claim. Instead, what we're doing is we are lending money to the state. And so this looks a little bit more like a Venetian financial crisis when they're at war with Genoa in the War of Chioggia back in the 14th century. And the issue here was that if the citizens hadn't provided money for their government to fight this war in, well, they all would have been defeated and enslaved. So it seemed pretty obvious that we should mobilize society's resources for the betterment of society. And that's what we've done here in Canada. How we unwind this will be tricky. There's been some political opposition to the idea of politicizing the Bank of Canada, having the Bank of Canada directly buy government debt that's not necessarily related to COVID. So there is going to be a reckoning on this in 2021. And a major hope is that we don't pull the plug on our emergency financing before we're done with it. In general, most people would argue that we can deal with a reckoning of the crisis after the crisis is done. And even Aaron O'Toole, who's been out in the press screaming about deficits for the last month, was very clear about saying that I don't like deficits, but it was the best option that was available. So he wants to be, cognizant of, money running away. But even the people complaining about the deficits recognize that that was the best option that was on the table. So we expect that there's going to be a substantial amount of government debt in the future that our system is going to need to find a way to metabolize. The only concern that we really need to be focused on in that space over the next 6 months is whether or not the government can continue to borrow from the banking sector through the Bank of Canada at the rate that it has. Right? If the next 6 months of government spending looks like the last 6 months of government spending, the government's new debts are going to start to crowd out other potential investments. It'll be harder for other borrowers to raise capital in a world where the government is vacuuming up everyone's savings. So this could potentially be a problem. Unless the government at the federal level is able to start trimming back some of its spending, there are real concerns about whether or not the banking sector can continue to supply this kind of cash to the Bank of Canada. They are well capitalized and they are buying very safe government debts, or at least providing the money to buy very safe government debt. But that doesn't remove the problem entirely, because we could effectively be throwing good money after bad by simply financing projects that don't create additional value. So that's my bit on government response. Next, I want to talk about markets, because a question that has come up a bunch of times this semester with people is, why the hell is the stock market at the same level that it was before the crash? And people are just blown away by this. It doesn't make any sense to them. They're like, there's a giant pandemic and people are out of work and corporate earnings are down in a number of sectors, and yet the stock market is hitting new highs. How the hell is this even remotely possible? So I'm going to show you a little piece of math in Excel. That's probably the easiest way to do this, quite frankly. So I'm going to share this with you just so you can see how this works. And it should explain to you the basics of this model. So what I'm going to do here is I'm going to rely on a really, really simplistic model that you're all familiar with. And this is this model where, let me just make this much bigger so it's easier for everybody to see. The model I'm going to work around is one where price equals cash flow.
Well, I don't think you're actually sharing.
Oh, crap. Let me fix that.
I'm just seeing your Excel open file.
Oh, okay. Give me a second. I will try to do that again. Can you guys see that Excel sheet now?
Yeah.
Okay, cool. So the model I'm going to run is really simple. It's basically cash flow divided by K minus G, or the discount rate adjusted for growth, right? So everybody's seen this kind of model before in intro finance. It's pretty straightforward. So let's put in some really basic numbers here just so that we can imagine things. Cash flow, K, G, and the price that results from it. So my formula is going to be that equals that divided by that minus that. Nice and easy. So I'm going to start off with cash flow of 1. My life is easy. And K is actually going to be made up of components. I'll put in 2% growth here because that's pretty easy. K is our cost of capital, right? So our cost of capital, generally when it comes to equities, comes from this. Your cost of equity is equal to risk-free rate plus beta times market risk premium. Now, looking at some of the basic inputs for the CAPM model, our risk-free rate prior to the pandemic was about 2%. Beta for the entire market is by definition 1. Market risk premium in Canada is generally about 5%, give or take. So our cost of equity prior to the pandemic was about 2% for risk-free plus 5% for equity risk, meaning our original cost was 7%. So you can see how $1 worth of earnings gives you a $20 stock, basically a price to earnings ratio of 20, which is pretty close to what we had. Now let's imagine this under pandemic world. In pandemic world, first thing that happens is the cost of capital changes. Remember that our risk-free rate here originally was 2%. Today, our risk-free rate is 0.25%. Beta for the market remains 1. Market risk premium remains 5%. Therefore, my cost of capital, while over here it was 7%, has now fallen to 5.25%. Now, if we assume low, stable growth, I picked the 2% growth because we're not talking about a single company here. We're talking about a national economy and the rate of earnings growth companies for the entire, who are listed in the entire stock market. So 2% growth is pretty close to in line with the rate of economic growth that Canada can reasonably expect over the long run. So I used 2%. You could try something lower like 1.5%, but you can note here that if I put in 5.25%, my cost of capital and keep 2% growth, watch what would happen if there was $1 worth of earnings. Under those situations, had we cut the cost of capital, the stock market would have risen by 50% anyways. So what happens if I say cut earnings by 1/3? So we only have 65% of the earnings that we had before. Wow, fancy that. You can cut earnings by 1/3 and still produce the same price because of a reduction in the cost of capital. So that's the answer to the mystery of why the stock market is where it has been, where it was back in February. If you want to understand sort of what our future looks like, as this cash flow is restored, so as our economy starts to come back to normal, that price is going to rise. When we hit 75%, stock market's going to be 10, 15% higher than it is now. At 80%, we're going to be a full 25% higher than now. By the time it's fully restored, 50% higher than it is today. But again, that's assuming that the risk-free rate won't change. It very well may change at that time. We should expect interest rates will begin to rise once this pandemic passes, because an interest rate of 0.25%, while it's appropriate during the crisis, would not be appropriate for us to sustain going forward. We tend to target an inflation rate of 2% at the central bank, and for the central bank to intentionally hold rates about 2% below where they should be, to offer even a 0% real return for people, they're not going to tolerate it for that long. Canadians aren't forced to lend to their governments, and so they will simply move to other asset classes, which means that if the Canadian government doesn't want to run into the kind of problem I was describing earlier, where our bond market can't necessarily absorb their borrowing, they may have to offer higher interest rates. That's going to put our government in a difficult position because of the deficits we've been running. The cost of being in debt will rise as those interest rates go up, but we should almost expect them to. But in the meantime, the model is pretty clear about how this is going to work. Even at 65% of the original earnings that we had a year ago, given the reduction in the risk-free rate, we should expect stock market prices to be about the same as they were. And that's exactly what we see with the TSX sitting around the same level that it was back in February. Same sort of thing is happening in the United States. Reduction in the cost of capital is really leading to significant increase in stock price because the rate at which we discount those cash flows is reduced. Another thing about markets that's useful to consider, some rates. So I'm going to put these numbers up on the screen for you guys so that once again it's easy to see. But here's some key rates in terms of investments that you might find useful to know. Let's take a look at what we can invest our money in. Let's say treasury bills, right? Short term, nice safe government debt. Wow. 0.25% interest per year. Okay. How about longer term government debt, say 10 years or more? Turns out Bank of Canada reports that at being at about 1.2%. So, wow, even if I lend my money to the government of Canada, I'm still losing to inflation, which is sitting right now at about 1.5%. If I pull up current CPI or inflation rate for Canada right now, what we're looking at last year was about 1.95%. Looking for this coming year, the inflation rate for 2020, it's going to be very tame. We're talking probably about inflation of only 0.5% in this particular case. So given that we're looking at 0.5% inflation, T-bills are losing you money. Right? We have negative real interest rates. Your 10-year bonds are basically keeping up with inflation. You might say, okay, that's fine. I'll take some risk. How about corporate bonds? I want to take the corporate bonds that are still investment grade, but which have the highest yield possible. And those are rated triple B. In the US, those are currently yielding 2.16%. That's still not very much, quite frankly. In Canada, the triple B rate average is a little bit higher than that because our market's not as liquid in America. But we're talking about a world where our returns are piss poor. I put in an inflation estimate of, say, 1% for the year, right? I know it's estimated about 0.7, so let's use 0.7 instead. Our real returns are negative for T-bills and pitiful for everything else. Could you imagine accepting the risk of a corporate bond fund to earn a real rate of 1.6%, especially since the government's inflation target is, or the bank's inflation target is 2%. So if the Bank of Canada gets its way, all of these investments are basically underwater. This requires us to start looking outside of safe bonds, because at the end of the day, it's not exactly safe to lose money to inflation. You're actually better off trying to earn at least some sort of real return. Admittedly, these are better than money under the mattress, but you're still losing on a real basis when it comes to T-bills. So the super safest securities you can buy are actually eating into your purchasing power. What alternatives have you got? Well, if we take a look at the TSX index, the average dividend payout for the entire TSX index, 1% higher than the best investment grade bond yields we can get. Now, it's probably about a 75 basis point spread above Canada's corporate triple Bs, but we're also looking at the dividend rate on just buying the TSX index, which is not necessarily a high dividend yield. It incorporates companies like Air Canada that are losing tons of cash right now too. So if we get a little bit more specific and we start to look at, say, companies that are still sustaining their dividend, or we try to look at a fund that's offering a high dividend yields, examples of that, for example, Vanguard has a high dividend yield fund that's currently yielding about 4.1%. Trying to find a dividend yield that is higher than 5 is almost impossible right now, at least for a broad fund. You can find individual securities that'll offer a high dividend yield. Let's look at BMO dividend yield. BMO's current dividend yield, 4.14%. TD, 4.3%. Bank of Nova Scotia, 5.1%. RBC offering a 3.9% dividend. So there are reasonable assets out there to purchase, but you have to be a little bit more selective than simply buying everything in the market. Buying index funds is a very useful strategy for people who are passive investors, and I would not want to undermine it. If you are interested in being more enterprising, and what you want to do is start thinking about things like sector rotation and asset allocation strategies. So let me see, what else have we got? The influence of the US on our market. This is something we cannot avoid under pretty much any circumstances. We are effectively stapled to the United States, right? We are like, Belarus and Russia. If things go well in Russia, it'll be fine in Belarus. If things go well in America, it's fine in Canada. If America turns into a dumpster fire, we're going to choke on the smoke. That's the best way to put on it. So we really do have to rely on America getting back on its feet to some extent. So if things go badly there, we don't have a choice. It's going to go badly here too. But if things go well in America, if they manage to pull themselves out of this in the next, say, 6 to 9 months, if their recovery goes well, the biggest indicator for Canada's future success is whether or not American stimulus spending will have a Buy American provision. If American stimulus spending has to be spent on American firms, which they are very likely to do, quite frankly, economic nationalism is not a Donald Trump thing. It is an everybody thing. If Americans have Buy American provisions that don't bring in the circle of NAFTA, so we don't have that sort of economy of North America working together, it will be much harder for us because we are often the primary producers that create the raw goods that will fuel their expansion. We create, we send them with softwood lumber for their housing industry. We provide them with nickel, copper, and a variety of other industrial resources that they use. They buy our potash to fertilize their farms. But if all of the American stimulus money gets spent on Buy American provisions, we're going to bleed from that because we're counting on their money to bounce our resource firms back and to create some jobs that will aid in Canada's recovery. So that's a key thing to watch for, is whether or not Americans are going to include Buy American provisions in their stimulus. One of the things to note about moving into markets, by the way, just as to kind of close off my talk on markets, even though it might seem reasonable for us to think about how things are going to turn around 6 months or 9 months or 12 months from now, be careful about being early in the market. The market is littered with the corpses of traders who moved too early. That's the best way I can describe things. Being right at the wrong time still means you're wrong. As an example of that, Julian Robertson, who ran the famous hedge fund Tiger Management, bet against technology in 1998 and in 1999, and it cost his hedge fund billions of dollars in losses because even though he proved to be right in 2001, 2002, the problem was Tiger Management closed its doors on March 30th of 2000, right before the stock market took a tank. So Julian Robertson would have been vindicated. However, the old saying in the market that the market can be irrational longer than you could be liquid holds true. And therefore, being right at the wrong time is still wrong, right? So you want to be cautious about when you move back into the market. I would encourage you to look for multiple factor confirmation rather than simply hope. Hope is a terrible, terrible financial strategy that will leave you in poverty. Better to think defensively if you are not planning to run your investment portfolio like a business. That's one sort of words of wisdom from Benjamin Graham, from the original Intelligent Investor from 1949. If you're not willing to run your investments like a business, then you should just adopt a broadly defensive portfolio and not try to beat the market. That's actually what I recommend to most people. Buy some broad-based defensive funds, sit on it for a year. Let's see how things go. And if it turns around, you'll have plenty of opportunities to make money. Also, if you're young, and what I mean by young is under 40, I can pretty much guarantee that there'll be another financial crisis between now and retirement. So if you're sad that you missed the great buying opportunity back in April, there'll be another one. For people who were sad that they missed 2008's big crash followed by recovery, well, they got another one 12 years later. Expect to see the same thing, I won't say in 10 years or in 15 years or even in 5 years. All I can say is that over the next 30 years before you're done working, there'll be another one. So watch out for those kinds of opportunities. But again, don't move into markets too early. There's still a lot of blood left to come. When it comes to making investments in speculative beaten down sectors right now, like airlines, I would tend to discourage it, particularly for defensive investors, simply because there's going to be a lot more bankruptcies in those kinds of beaten down spaces yet. It'd be like opening a restaurant. Right? Yes, it might be good to open a restaurant once all of the competition has died off in the next 6 months, but opening a restaurant today might be a silly idea. So make sure you time your entry to coincide with an actual turn in the market. You might remember from 602, I discussed leading indicators. One of the leading indicators for this would be an expansion of total payrolls. Right, so because companies will tend to pay more overtime before they start hiring new workers. So if companies start seeing increases in total payrolls, that's an indication that they're starting to bring in contractors and getting their employees to work overtime. We will definitely see that before we see any kind of large-scale hiring taking place. So we are seeing some recovery right now. We are in the process of bouncing back from the hole we were in second quarter, but we're still well below where we otherwise would have expected to be at this time had it not been for COVID. Okay, final thing I want to mention real quick is about the changing aggregate demand and aggregate supply. In 602, you got introduced to this sort of model of aggregate supply and aggregate demand, the notion that we have only a certain amount of capacity to bring products to market, and that there's a particular structure by which we bring products to market. Similarly, we have aggregate demand, but aggregate demand is composed of specific components. And what's happening right now is even if aggregate demand is restored, and even if aggregate supply is restored over the next couple of years, the composition of demand has changed. The composition of supply will change as well. For example, what I mean by changing composition of demand, we still consume as much food in Canada as we did before COVID. We just get it from different places now. We get it from grocery stores instead of restaurants, for instance. And so even though the total aggregate demand for food might be the same, the kinds of products we buy are different. The kinds of things that are bought by restaurants are not the kinds of things that we necessarily buy for home preparation. And so even in terms of running an operation like Maple Leaf Foods, they have to switch internally what kind of products their factories are producing to meet the demand profile under COVID. So there's a lot of changes happening within organizations to try to meet that. And a lot of these changes are not going to be undone very easily. What I mean by that is that businesses will have adapted new processes during this time that will not simply be unplugged and put into a box. A few months ago, I was speaking with a project manager at BMO, and she actually suggested to me that a lot of, unless they have branded office space, they're not going back to it. In other words, where they used to have call centers working out of various office towers, if it wasn't branded BMO, they're not going back to those expensive places. They've realized they can get people to work from home, and that's what they're going to do. So there's been a lot of businesses that are changing in that sort of structure. Small businesses have hurried online, which will open up a lot of new customers for them. The move to digitization that Canada was sort of, foot dragging on has now been accelerated. And so one of the key things that will allow us to find good investments for the future will be trying to understand which companies have adapted most rapidly to these kinds of changes. Were you able to switch your method of delivering your particular product to something virtual? For instance, law firms did a very good job of rolling out digital tools for collaborating with clients, meeting with clients, and even going to court online. They were able to very quickly adapt. Consulting firms were very quick to adapt. Restaurants, very slow to adapt. So service providers have usually been those that haven't been as badly hurt. But remember that if your service requires face-to-face meetings, like say sit-down restaurants or live music, that these industries are going to be almost likely forever changed. And it's going to be, I'm going to guess, probably 4 to 5 years before we start seeing a return to normalcy, if that ever comes back in that sense. For some of these industries, they will simply have changed the assets that they use for production and for delivering their services in that time. And they're unlikely to change them back. They're more likely to simply run through those assets and then change their strategy as those assets are depreciated. But they're unlikely to simply take a plan that they had rolled out for COVID and put it away in a box. So one of the things to watch for in terms of selecting industries is their adaptability. If they had to endure significant capital costs to make adjustment for COVID, you can bet that they will not be switching back anytime soon, because nobody wants to make large capital expenditures to both change to a COVID world and then change right back from it a year and a half later. Otherwise, other things to watch for, I would point out that as usual, it's easier to pick out losers than winners. Trying to pick out winners is what everybody does in the stock market. Statistically, though, if everybody's looking for winners, there's a lot of competition for winners. How about losers, though? You can identify and short sell losers. That's going to be a very valuable enterprise for those people who are willing to put in the time and take the risk. But again, unless you're willing to operate your investments like they're a business, you're better off just buying a defensive fund of value stocks, things that are utilities, healthcare, defense industry, that sort of thing, that'll just provide stable dividends, things where demand hasn't collapsed. Those are your best bets, I would say, for the future, at least for the next 6 to 9 months. In general, I would meet up again next summer to reevaluate your portfolios and consider shifting them. But for now, you want to maintain a very tight defensive position because it's going to be difficult for the next 3 to 6 months, for sure. There'll be a lot more people dying. We're going to have a lot more businesses going under, and it's going to get worse from this point before it gets better, in my opinion. Okay, that wraps up pretty much everything I got to say. happy to take questions if anybody's got anything. If anybody's got a cool idea to discuss. Let me pull up the chat really quick. I haven't been watching.
I have some questions, but I'm outside the class, so
no worries, Brandon. That's fine. They're outside of class too. Their class ended like a week and a half ago.
Okay. You talked about sectors that are doing well and sectors that are doing bad. For my own benefit, because I'm dealing a lot with them in my job here, is mining, oil and gas, and forestry.
Yeah.
What's the outlook? Where do they lie on that spectrum?
Well, overall, in terms of how well things have gone, RBC identified that the agriculture, forestry, fishing, and hunting sector was doing well, interestingly enough. But in terms of natural resources, most of that is dominated by international considerations because they're international commodity markets like price of nickel, price of copper, softwood lumber, oil, etc. That has bounced back a little bit since Q2, so it's not as gloomy as when the oil price and Western Canada Select went negative. It's not quite that bad anymore. We have seen a bit of a rebound in certain key commodities. I suspect a lot of that is aggregate demand from China. And as long as China stays pissed off with Australia, they might buy our stuff.
Yeah.
But they're mad at us too, so we'll see how that goes.
Speaking of political factors, and I see Muhammad Sharif actually preempted me. What do you think the factor on COVID and the economy is going to do with the Biden presidency, or is there still volatility to be had considering a non-concession by Donald Trump?
I'm not too worried about non-concession by Donald Trump, quite frankly. And at the end of the day, I think my faith is on. And I hate to say it because it sounds super weird for punk rock me. I have an perhaps inordinate amount of faith in the professionalism of the U.S. military. And there is no way in hell they're going to let a complete moron be their commander-in-chief and order them into a catastrophic war, for instance. For instance, if Donald Trump was like, hey guys, time to nuke China, I'm willing to bet his generals would just arrest him on the spot. Because they don't want to die, and they're not going to just follow orders because they were given them. And so I'm not too worried about Trump hanging on here. A bigger concern, though, is the space Biden has to work in. Right? Biden has to some extent, placate his nationalists. And it's going to be really hard to say that we should spend American stimulus money on buying stuff from Canada. That's always been the case. Even in 2008, it was really tricky. You had a lot of countries that wanted their stimulus spending to stay within their own country because there was this fear of free riders. And the European Union totally free rode the Chinese and the Americans. Between China and America, they spent like $1.5 trillion in stimulus. The entire EU spent $200 billion. So they don't want to get caught with the free rider problem again. And that's why you're likely to see these kinds of America First provisions. As much as some people are like, yes, Biden will restore things to the way they were before, he doesn't always have the power to do that, right? He's got his own set of constraints to operate in, and American presidents are often a lot more constrained than people realize. So that's why I flagged it as being a big risk. We'll have to see what the structure of it is. He could decide to go very internationalist on this and be like, hey, we're going to do our stimulus spending within like the Five Eyes country or something like that. He could pick like kind of, the circle of American friends and keep the money there. But until we have some idea of how that stimulus spending in America is going to get directed, it's the big open question for us.
Yeah, geez, it's I keep saying to brokers here, up is down. One of the questions that I had about that I just forgot. So
jump back anytime.
Yeah.
Anybody else?
Oh, that was the question. Is an interesting thing on the gold thing that I've seen and is not only did gold go up during the lockdown, but gold mining companies went up by
Yeah.
like a lot. And from a risk perspective, it's not like more gold appeared in the ground.
That's right. What happened is people don't know how to buy gold.
Yeah.
So they
Yeah.
assume that gold companies will correlate with the price of gold, but that's not always true. It's a messy signal.
Mm-hmm.
But yeah, we have seen gold rise. Bitcoin tripled.
Mm-hmm.
Right. So the biggest thing I see is that a lot of people are obviously concerned about inflation. They're concerned about the amount of government money creation. They're concerned about central banks providing this kind of emergency financing to governments. They're concerned about rolling our savings over into social programs that may or may not create value. My best advice to this, looking at the history of inflation and hyperinflation, is to consider how they managed to stop hyperinflations once they happen. In Zimbabwe, they did it by just removing the currency and going to US dollars. Instant stop to hyperinflation. Really problematic, but no more hyperinflation. In Germany, in 1923, with the hyperinflation, after the French invaded, what they did to resolve it was they stopped having government currency that was based off of a fixed number of pieces of paper they'd hand you, and instead they moved to what was called the Renten mark. The original, the one before that had been the papier mark, or the paper mark. That was basically government says it's worth something. But the Renten mark was actually paid out. It was a bond that paid out based off of the productivity of factories and the amount of money that was collected on rental units, because like 75% of people in Germany rent. And that was the case then too. So what happened is there were real productive assets that underlay the value of that currency, and that stopped the hyperinflation in 6 weeks. Everybody knows the story about like, oh, wheelbarrows full of cash, but nobody seems to know the story about how they got it under control. And so the link was to own real productive assets. And what that means, the takeaway from that is that if you want to protect yourself from inflation, you need to buy real assets that have productive yield, right? Owning gold, what the hell would a yellow rock do for you anyways? Like, it was valuable in the days where there was 100 little kingdoms and I needed to smuggle my money out of a collapsing kingdom in a way I could carry. That's not what's going on anymore. So similar to Bitcoin, gold doesn't have any yield. And that's my biggest concern. Yes, people argue that it's a hard asset, but I tend to prefer things like productive agricultural land or buildings or shares of corporations who have pricing power and can keep up with inflation. So in that context, the only thing I would say is that if you really are afraid of inflation, buying bonds right now is probably a bad idea.
Hello, Will. I have a quick question.
Sure, man.
You said try to pick out losers rather than winners, and you said something about shorting. Can you explain a little bit more about that?
Do you know what short selling is?
I know, like, you can bet against the bonds. That is shorting, right?
Yeah, you can bet against anything in that sense. Basically, what you do is you borrow it at today's price, you sell it, and then you're going to have to pay that back. If you are unfamiliar with the mechanics of shorting, I do not recommend you start doing that because I said it. Right, like it is not a sophisticated operation, but I would tend to say it's not appropriate for my parents to do this.
Mm-hmm.
So depending how risk tolerant you are, how sophisticated you are financially, how comfortable you are with it, it's not very hard to get a short position. You need to have a margin account rather than a cash account with your broker. And the only reason I bring it up is because most people focus on trying to win. And 90% of people are looking for winners, which means there's a lot of losers out there, right? That people just aren't paying attention to. And honestly, the easy strategy, that we solved this one out in quant finance several years ago. You buy the index and then you short the 10% of the index that looks like they're going to be the worst, right? Because you have this distribution of returns and you can try to capture the upside entirely and be like, oh, I want all the high returns. But if you could just cut out the losers, then you'd actually have a much better evolution, even though you have stochastic volatility. As long as you don't have any of those really big losses, like the 20 and 30% losers, you're fine. So what you do is you hedge, you buy them in the index, and then you short sell them to get rid of them in the index. But yeah, you can hit me up if you want a little bit more detail on short selling. But in general, if you don't have a margin account already, you should not open a margin account so that you can short sell stocks. I do not want to encourage anybody to take risky financial decisions unless you are very comfortable doing it yourself.
Yeah, I just needed to know more about that.
Oh yeah, open a margin account.
Yeah, I think even in 2008, the real estate people shorted a few bonds, right? And then Morgan Stanley had to pay them off, and then that kind of they had to pay in millions of dollars, and then that led to a downfall, right?
That's a bit confused. There's a few different elements in that story. Yes, there was some shorting of specific mortgage bonds that happened. I'm sure you saw The Big Short, right? Like Metallica drummer or the air drumming doctor who loves Metallica, who shorts these mortgage bonds, right? Christian Bale played him. Anyways, that's still a relatively sophisticated operation. You've got to find somebody who's willing to sell you these individual bonds, and you've got to be able to detect which ones are going to be the losers. So that's not a simple operation.
Well, I know,
but it does have better potential than trying to identify winners, because that's just a really crowded space.
I see. Thank you so much. Okay.
Yeah, the idea is to, rather than chase the top end of the distribution, I guess for you guys it's here, rather than chase the top end of the distribution, we try to identify the losers and just cut them out. Buy everything except the worst losers, and we'll end up with a better result.
Okay.
Yeah, that's the kind of strategy like a pension plan or an insurance company or like an actively managed portfolio can take, but I'm not sure it's appropriate for any individual to necessarily start doing that. Let me see. Oh man, I'm not going to predict volatility. Get a Garch model for that. That's beyond my pay grade. If I could predict volatility, I'd make a fortune trading options. I suspect that people are beginning to grow a little bit complacent with markets, and they're getting used to markets just going up. And I suspect that is a bigger downside risk. If people start to lose their confidence, if we start to see really bad earnings in first quarter, or heaven forbid fourth quarter in the US, you'll see some more downside and volatility will rise. But strictly in terms of being able to predict volatility spikes, nope, I got nothing. Build a Garch model, that's your best bet.
I just did a face when you said Garch model.
You should. Garch is a horrible, horrible thing if you don't know what it is. It's generalized autoregressive conditional heteroscedasticity. It's quite the mouthful. Basically, it's a model for forecasting volatility based on what it has been. Anyways, any other questions, anybody? Useful I can answer for you? See, it says one more question. Some stocks have performed really well, yet tanked because they didn't offer guidance. Why is this happening given that the trends are looking up? Can't tell you, other than I would tend to assume that at this time of year in the Northern Hemisphere, people's risk aversion is up. After 9 months of stay-home COVID trauma, people's risk aversion is up, and they want somebody to tell them it's going to be okay. And that includes their corporate bosses. They really want to hear what the earnings are going to be. And if you can't tell me what the earnings are going to be, I suspect it's because they're going to be really bad. So it's a basic psychology game where those that have high quality earnings will signal it by announcing it, and those that don't will be cautious about having to tell anybody unless they absolutely have to. It's kind of like the lemons game. People that have good cars are happy to tell you they have a good quality car, and they will pay a mechanic to verify it. People with crappy cars will be like, whatever, it's sold as is. Same sort of thing might be happening with guidance and earnings. Can't say for sure, but it's a reasonable estimate. Okay, so it's 8 o'clock. That wraps things up. If you guys have any other kinds of questions and stuff like that, you can, of course, hit me up. You're still students at Mac, so I still technically work for you. Well, I guess maybe we'll see where things are at. Maybe I'll have another course that I can offer you guys at some point in the future, but otherwise, take care, everybody. I've got to get down to getting your projects finished up. So that we should have final grades actually by the end of the week if you haven't seen them yet, would be my estimate. So they've been submitted. Most of the projects are done. There's some available feedback if people have specific questions, but overall, I would say for the most part, they were pretty well done. Otherwise, take care, everybody. Stay safe over Christmas. And hopefully we'll have a chance to meet up at one of the residencies on campus once the vaccine actually rolls out. Until then, stay safe. Talk soon.
Thank you very much, Will.
Take care, Brandon. Nice talking to you too, man.
Yeah.